It's not, okay. Good morning, everyone. If I can just ask that we all be seated so that we can begin with today's proceedings. Governor of the South African Reserve Bank, Lesetja Kganyago, to officially open this event. Thank you very much.
Good morning. Thanks, Ketiwe, and welcome to the SAP's 2023 Biennial Conference. It's an honor to have so many distinguished guests join us here today. It has been 2 years since we held this conference, yet the aftermath of the COVID-19 shock continues to affect the global economy, presenting old and new risks that continually test global policy settings. We have now entered a challenging phase of the global recovery. Following a post-pandemic economic boom, global growth has once again slipped below longer-run averages. Global disinflation is underway, yet targeted inflation remains uncomfortably high, and underlying inflation is starting to look sticky above many central bank targets. Moreover, debt levels have been substantially posing risks to macroeconomic stability in many economies. This year's conference brings together international thought leaders to reflect on the main challenges faced by central banks and macroeconomic policymakers. This conference looks at 4 key questions. First, we look at how major economies are likely to return inflation back to target and stay there, and the risks and issues involved with that process. Second, we will gain perspective on the impact of the global financial cycle on emerging markets. Third, we will advance a discussion on long-term risks and structural challenges, focusing on the impact of climate change adaptation and mitigation on economic growth. And finally, we will look more closely at how emerging markets can maintain a stable macroeconomic environment through better macroeconomic policy coordination, in part with reference to South Africa's experience. This event provides an opportunity to explore ways to navigate these challenges and ensure effective policy making going forward. I take this opportunity to also welcome my colleagues, the governors from the SADC region who have been able to join us in this meeting, and I am sure they will be asking fairly difficult questions, because the one thing governors do not lack is a battalion of people willing to advise. So since the advice will be coming for free during these sessions, we will be approaching you. And let me also take this opportunity to thank in advance our speakers during this conference. I very much look forward to an engaging and an interactive discussion during the course of today and tomorrow. And with those few words, I declare the conference officially open and would hand over to our program director.
Thanks very much, Governor. My time here is short. Rashad, I will hand over to you. Thank you very much.
Good morning, everyone. And on behalf of the SAB, let me also take this opportunity to welcome you to the Biennial Conference. I apologize that we couldn't have this meeting in beautiful, sunny, pothole-free Johannesburg. Unfortunately, we had to have it in Cape Town. I'm delighted to be able to chair the first session. We have a fantastic panel. What I'm going to do before I introduce the panel, just to say that in the way this session will be structured, is every panel member will have, we have very precise instructions from the conference team, 23 minutes, give or take, to present. These are all fairly self-contained presentations, but like anything in the world or in monetary policy, they ultimately connected. And then I'll immediately open it up to Q&A. At least two of the people in front are part of a proper panel discussion at the end as the last session in the conference. So let me take great pleasure in introducing our three speakers this morning. Firstly, Raphael Bostic, who is President and Chief Executive Officer of the Federal Reserve of Atlanta. The details of the CVs of our presenters are in the pack, in the app, so I'm going to be very brief. Raphael Bostic is the 15th President and Chief Executive Officer of the Federal Reserve of Atlanta. We have second Huw Pill, who's the Chief Economist and Executive Director for Monetary Analysis at the Bank of England. He is a member of the Monetary Policy Committee. And we have Giovanni Ricco, who is a professor of economics at École, Polytechnique, and the University of Warwick, and has a real interest in South Africa. So without any further delay, we have until 11:30 for the session, so we have a good time to do questions and have a robust discussion following the presentations. As you know, the first topic is back to target, monetary policy and advanced economies. I'm sure the less you hear from me, the better you are, because you're obviously here to come and see the presenters. So let me start off with President Bostic.
Thank you. Am I using this mic? Okay. I'll just say, first, good morning, everyone. It is very good to see you. I want to thank the Governor, members of the Monetary Policy Committee, and the great team at the South African Reserve Bank for having me. It's really flattering to be invited to speak here at this conference, and I'm really looking forward to learning from all of you over the next couple of days and sharing a few thoughts on the challenges my colleagues and I are facing in making monetary policy in the United States. I almost messed up the technology right off the beginning. Usually it takes about 5 minutes for me to do that, so I'm feeling really very much at home here at this conference, so it's really good to be here. I have to say, I see this conference and my participation in it as an opportunity to further advance the relationship between the Atlanta Fed and the South Africa Reserve Bank. Many of you may not know that staff members from our survey center are collaborating with colleagues here to construct a study of the payment habits of South African consumers. This project is modeled on a similar study our bank leads for the Federal Reserve System, and I hope it can lay the groundwork for many, many more partnerships. When I was asked to discuss challenges in the U.S. monetary policy making, I figured it was a straightforward assignment, mainly because challenges exist in so many places. Today, I will discuss what, in my view, are the most important challenges we face right now, and these mostly come down to one word: inflation. I'll begin with a word about my current stance on U.S. policy, and then I'll detail the progress we have made in lowering the inflation rate and the adjustments I still want to see to feel absolutely comfortable that the trajectory of inflation is conclusively on a path to 2%. Now, before I do that, note that I use the words "in my view," because these are my views alone and do not necessarily reflect those of anyone else on the Federal Open Market Committee or at the Federal Reserve Bank of Atlanta. Now, you no doubt saw that the committee voted last month to raise the federal funds rate another 25 basis points to a level of 5.25% to 5.5%. Based on current dynamics in the macroeconomy, I feel policy is appropriately restrictive. I think we should be cautious and patient and let the restrictive policy continue to influence the economy, lest we risk tightening too much and inflicting unnecessary pain. And we're not supposed to be on this slide yet, so just don't pay attention to that. I'll let you know when to look. That does not mean that I am for easing policy anytime soon. Inflation in the United States is still too high. Now, there has been significant progress in the battle, and inflation is well off of the very elevated levels that we saw in the last year. But it's essential that inflation be brought all the way back to our target. We must remain resolute in the campaign for price stability until we see inflation is conclusively on track toward 2% over a reasonable time frame. Now, I just believe policy is already restrictive enough to get us there. Should conditions not play out the way I anticipate, and inflation or inflation expectations abruptly reverse course and start to climb, then I would certainly support doing what would be necessary to put the U.S. economy back on a path toward price stability. Now, I just quickly summed up my policy stance, but formulating policy is hardly a straightforward exercise, particularly in today's environment. The challenges I'll detail still stem mostly from a pandemic, the likes of which none of us had experienced. The United States lost 22 million jobs in 2 months. In the second quarter of 2020, the nation's gross domestic product contracted by 30%, similar in magnitude to what happened during an episode that we call the Great Depression. The enormous shock was especially vexing because it was utterly unlike a typical economic downturn. it did not result from excesses within the economy, but rather from a worldwide health crisis and significant necessary measures taken to protect the public. Amid lockdowns, many homebound Americans unleashed a shopping binge that overwhelmed production arrangements that were already taut due to decades-long efforts to design hyper-efficient, just-in-time supply chains. Limited factory operating hours and short-staffed ports and transportation systems, all of which resulted from the lockdowns and other public health constraints, exacerbated the strain. As COVID caused businesses to shutter and millions became unemployed, the American government responded with trillions of dollars in fiscal supports, including direct payments to consumers and businesses. Meanwhile, the FOMC slashed the federal funds rate to near zero and instituted lending facilities and other programs to support households, businesses, and financial markets. We aimed to nurse the economy through the worst of the pandemic, with the hope that we would come out of the other side with minimal long-term damage. Now, for the most part, I think we did that. Employment rebounded more rapidly than anticipated. In just over 2 years, employment returned to the level it was at on the eve of the pandemic. And by comparison, after the Great Recession of 2007 to 2009, it took twice as long to regain far fewer jobs. Along with other factors, the surge in goods spending that I mentioned helped spark the biggest inflationary spike the U.S. had seen in 40 years, beginning in the spring of 2021. Now, we expected price pressures to settle once extraordinary pandemic-related supply and demand factors normalized. But it turns out that it has taken longer than many anticipated for supply and demand conditions to return to their longer-term trends. To combat this inflation, the Fed has aggressively tightened monetary policy. We've raised the federal funds rate by 525 basis points over a year and a half. But I think here it's important to put those moves in the proper perspective. Not all of them represented actual tightening. In fact, I view the first 325 to 350 basis points as removing accommodation, and then the subsequent 175 to 200 basis points as moving policy into actual restrictive territory. Now, I'm gratified to say that the policy tightening has proven effective in helping to lower inflation toward our 2% target, as measured by the Personal Consumption Expenditures, or PCE price index. The decline in inflation has been relatively slow, and I expect that pattern to continue. Now, for the sake of clarity, and because we have it in hand for the month of July, I'm going to cite readings from the other major inflation gauge, the Consumer Price Index, rather than jump back and forth between the two measures. The latest CPI headline number came in at 3.2% in July, while core inflation, which excludes food and energy prices, was 4.7% compared to a year earlier. Now, those are down from a cyclical peak in the headline rate of nearly 9% in June of 2022, and the core peak of about 7% that was reached last fall. Now, focusing on July again, a closer look shows that core CPI for that month rose at just 1.9% annualized rate, matching its increase from June and declining sharply from its annualized growth rate of 5% through the first 5 months of this year. Now, those numbers suggest that a case could be made that if it were not for stubborn and lagging prices for housing services, the core CPI would be running at 2.6% on a year-over-year basis and just 1.1% over the past 3 months, which is a rate that is well below what we view as needed for price stability. So essentially, given the lagging nature of rental prices in the calculation of the CPI, and in the PCE for that matter, underlying inflation may well be close to our target already. Now, the trend in one alternative measure of inflation, the sticky price CPI developed by my staff, is giving me particular confidence that inflation is headed in the right direction. Now you can look at the slide. The sticky price CPI, which excludes food, energy, and shelter prices, was basically flat in both June and July, and as the slide shows, has risen just 0.8% annualized over the past 3 months. And note here that the lines in the picture here are all diving towards or even below our 2% target. Now, the sticky prices in our index include categories like personal care services, trash collection, medical care services, shelter, and education. In total, our sticky prices basket comprises roughly 2/3 of the entire CPI basket by expenditure weight. And because these prices are typically slow to adjust to changing economic conditions, they may contain an embedded inflation expectation component, and thus tend to be good forecasters of inflation 2 to 3 years ahead. Now let me describe a final data point that I have focused on for some time now because I think it too transmits a meaningful signal about the trajectory of prices, and that is the breadth of inflation. Now, the recent shift in the price change distribution has been striking. Over the past 3 months, just 35% of the underlying CPI components by expenditure weight rose at rates of 5% or more. And that's shown here in the slide. Now, this is still higher than the pre-pandemic average of 15 to 20%. But in July of 2022, which is just a little more than a year ago, that percentage was about 80%. Now, I don't think it's a stretch to call this another marker of significant progress. Now, the promising evidence is expanding. Still, even a large handful of data points will not prompt us to pop champagne corks just yet, because the economy is still beset by uncertainty, and we cannot be completely sanguine about any projections. However, in the remainder of my comments, I will make the case that our restrictive monetary policy stance is having a clear moderating effect on economic activity that should put further downward pressure on prices and thus promote a return to our 2% inflation target. Indeed, I believe Atlanta Fed surveys and numerous conversations with price setters offer convincing signals that the downward momentum of inflation is likely to continue. And I'll note that our surveys and grassroots information channels have a strong track record, so I feel confident in their predictive ability. Now, I'll start with the outlook for prices. Our Business Inflation Expectations Survey is a monthly canvas of 200 U.S. companies across industries and firm sizes. In the latest BIE, fewer firms say that they plan to continue raising prices, and those that do plan to raise them say they'll do it by smaller amounts. Almost 3/4 of firms reported that they increased prices of their core products or services in the 12 months through May of 2023. And the average increase here was 7%. By contrast, for the year ahead, 57% told us they intend to raise their prices, and by an average of only 4%. Other surveys from a research collaboration with colleagues at the Cleveland Fed and New York Fed show similar projections of less severe price increases to come. And finally, feedback from field staff in our Regional Economic Information Network offers still more confirmation that peak pricing power has most likely passed. The anecdotes pointing to diminishing pricing power and perhaps moderate slowing in economic activity are supported by preliminary results from the most recent Atlanta Fed Survey of Business Uncertainty, or SBU. In the most recent survey, year-ahead nominal sales growth expectations slowed from 5% at the beginning of the year to 3%, which is well below the pre-pandemic average for expected sales growth in the SBU. Now, turning to labor markets, there appears to be a measured cooling afoot there as well. After the jobs report in May showed a 1-month surge in hiring, the June and July reports showed employment growth continuing to moderate, albeit at a slower pace. And I will also point out that for the first 6 months of this year, the United States Bureau of Labor Statistics revised payroll employment growth downward by an average of 40,000 jobs a month relative to the initial release. So the labor market was not running quite as hot as we had originally believed. And based on the BLS's preliminary benchmark estimate, it looks like employment growth in the first quarter of 2023 will be revised a bit lower still. Now, furthermore, the job market may be cooling even faster than the headline numbers suggest, as growth in total hours worked has slowed more than growth in unemployment, or growth in employment, because of recent increases in part-time work. Now let me say a word on wages. Now, economists are concerned about how much wage pressures are influencing inflation, especially in services prices. And to be sure, debate continues about whether wages are a lagging or a leading indicator of inflation. Now, I'm not going to settle that question today. But what I will say is that via the SBU, we detect signs of current and future wage growth moderating. For the 12 months starting in May of 2023, the SBU says employers aim to raise wages an average of 3.6%, which is down from last year's 5.2%. And here let me offer a little context. For much of the past couple of years, elevated inflation made real wage growth negative after positive growth just above 1% before COVID. Given that, I would expect nominal wage growth to exceed inflation for a time, as real wage levels revert to the pre-pandemic growth trend. And in fact, over the past 3 months, average hourly earnings pretty comfortably outpaced inflation, as the slide makes clear. So the upshot is wage growth is moving back toward normal, which over the long term typically means an equilibrium level roughly in line with productivity growth. As long as firms continue to signal a slowing trajectory on price growth, that is, that they're willing to absorb some margin contraction, then real wage growth should not put upward pressure on prices. Now, our conversations with business leaders confirm that scenario. They tell us that they're raising pay so their employees' wages catch up with past inflation, and they are not anticipating having to raise prices in the future to keep pace with the higher wages. And as I noted, our surveys and conversations make clear that employers plan to taper down those wage hikes to normal pre-pandemic levels in the coming years. So I'm not overly concerned that a period of moderate real wage growth will rekindle inflationary pressures. Now, I've cited evidence this morning that I believe represents a convincing case that the rate of inflation will continue declining toward our objective of 2%. Reductions in planned price increases, cooling in the labor market, and ultimately a measured tempering of economic activity that will bring supply and demand into closer alignment. Now, having said all that, the economic journey ahead is far from assured. We continue to confront a great deal of uncertainty and risk. And we emphasize this a lot, but it's worth restating. There are no historic models to guide us through the shock of the pandemic. So in important ways, we continue to operate in uncharted territory as we aim to restore our economy-wide supply and demand to a pre-COVID equilibrium. The lingering effects of COVID, heavy corporate and government debt, the war in Ukraine, other possible geopolitical shocks abroad and at home, and extreme weather events are but a few of the risks facing the macroeconomy and thus the path to 2%. There are other more immediate risks that we're also watching closely. One lies in the commercial real estate business, particularly in the office sector in the US. The trend toward work from home has pinched some office building owners and lenders, especially those with older, less luxurious space. And higher interest rates make it difficult for commercial property owners to refinance debts that they may be having trouble servicing because occupancy rates are falling. Housing is another important component of the American economy, and there are concerns there too, mainly involving low inventories of homes for sale. And that pushes up prices and squeezes affordability. Rising interest rates play a role here as well, as homeowners are loath to give up existing low-rate mortgages to sell a home and then buy a different house at today's higher rates. The banking sector itself remains a source of risk as banks navigate a higher interest rate environment, though by and large the US banking system is sound and well capitalized. Commercial real estate, housing, and banking are all directly affected by interest rates. And as we administer medicine to the economy in the form of tighter monetary policy, the intent is to modulate demand to better align with supply and therefore ease upward pressure on prices. We need to be patient, let the medicine of restrictive monetary policy work its way through the economy, and not reverse course until it's clear that higher inflation is no longer a threat. So to reiterate, I think the facts that I've assembled here argue for a patient, resolute, and cautious approach to monetary policy. Patient, so that our policy can work through the economy and continue to gently rein in economic activity. Resolute, to hold policy at an appropriately restrictive place for as long as it takes to be certain inflation is bound for 2%. And cautious, because I think we now risk over-tightening and inflicting unnecessary damage on the labor market and wider economy. And on this last point, we need to be cognizant of passive tightening, as falling inflation means real interest rates will rise even as the nominal rates of the Fed influences remain stable. Now, should the data not come in as I expect, for example, if inflation or inflation expectations start climbing, and it becomes clear the committee must tighten further to keep inflation falling, then I would clearly support that. Given widespread economic activity, I do not expect our path from here to the 2% inflation objective, the last mile, if you will, to be without curves and bumps. But we will get there. Be assured I am committed to restoring price stability so that American households can enjoy maximum employment, an economy that works for everyone, which is the tagline for the Atlanta Fed. When we achieve this, the resultant stable, healthy US economy will be a clear positive for economies around the world. And at that point, we can work together to ensure that all of these economies increasingly work for all people across the globe. I look forward to helping bring that reality closer to fruition. Thank you.
So, good morning, everyone. And let me first of all say how grateful I am to be here, and thanks to the Governor and his colleagues at SARB, and particularly Chris, for the invitation to speak at this event. I'm sure I'll learn a lot, I already have, from the outstanding agenda that's been prepared. It's a particular pleasure to be here in Cape Town. Obvious reasons, it's a very beautiful place, but there's also a specific reason which I hopefully will have time to get to before the end of my remarks this morning. And I should say it's a great privilege to be sharing the stage with such a distinguished panel as well. So Chris asked me to look at a combination of three issues: the second round inflation problem, which perhaps is one the UK faces in particular, the efficacy of monetary policy transmission, and also the joint implications of those two things for policy setting in the current challenging environment. So that's quite a big task to address those 3 points, but I will touch on them. But before I do so, and recognizing that we have another session on policy tomorrow, I do just want to emphasize that in a session with the title Back to Target, in the UK, inflation remains too high, well above target, and there is no real room for complacency. Of course, we do draw some comfort from the recent decline in headline inflation, which is our targeted CPI measure, but there are also cases for caution. Core inflation in the UK, excluding food and energy, remains stubbornly high, and indicators of underlying or the more persistent components of inflation, the MPC has identified 3: wage growth, the tightness of the domestic labor market, and services price inflation. Those indicators of those 3 phenomena, they've developed less benignly of late. And given the lags in monetary policy transmission, the famous long and variable lags, it's that persistent component of inflation that we have to focus on, because it's that persistent component of inflation that will still be with us when the lags in policy transmission unwind. So over the last 2 years, year and a half, the MPC has done a lot. Bank rate has been raised by 5.25%. We've halted QE and started reducing the balance sheet. And we've changed our communication about monetary policy in significant ways. As a result, and given the lags in transmission, there's a lot of policy in the pipeline to come through. But at this stage, in my view, and I think consistent with remarks that Raphael just made, the key element is that we on the MPC need to see the job through and ensure a lasting and sustainable return of inflation to the 2% target. We certainly need to ensure that we do enough with policy to make that the case. There are risks on both sides. Now that policy is in restrictive territory, there is the possibility of doing too much and inflicting unnecessary damage on employment and growth. But at least in my personal view, at present, the emphasis is still on ensuring that we are, in the words of the MPC's last statement, sufficiently restrictive for sufficiently long to ensure that we have that lasting return to target. So having said that, let me sort of move to putting our discussion in context and addressing the fallout from the recent pandemic and other events. So I'm going to echo Raphael a little bit here, and hopefully I can run quite quickly through this backward-looking part. The COVID emergency was a health emergency which led to a disruption of the economy and the introduction of a variety of lockdowns. In the context of those lockdowns, there were changes in the pattern of demand. You couldn't go out to restaurants, you couldn't purchase consumer-facing services in many respects because you were stuck at home. As a result, we saw an increase in the demand for goods, and as Raphael said, particularly in the US, that increase in demand for goods was also supported by fiscal expansion. At the same time, and meeting that, the same lockdowns in other parts of the world led to a restriction in supply and a disruption in the shipping of goods, which were in many cases made in East Asia to where that increase in demand was taking place. So you don't need to be much of an economist to see stronger demand for goods, weaker supply of goods. What will that do? It leads to an increase in the price, global price of consumer durables in particular, which was what was taking place during 2021 as I joined the Bank of England and the Monetary Policy Committee about 2 years ago. For the UK, as a small open economy, we are a price taker in global markets for goods, which are very strongly traded. And I think there's a resonance here with South Africa and other countries represented in this room. We are not able really to influence the international price of goods. We are taking what that evolution is. There is a role for the exchange rate, and I'll come to that in a moment. But there was a big, strong inflationary impulse coming as a result of the pandemic into the UK economy. So as you can also see on this chart, by the time we got to the middle of last year, the middle of 2022, some of the rebalancing of demand had taken place as the lockdowns moved away and the pandemic receded, and the supply constraints eased, and that led to some decline in the international price of goods, which, other things equal, would have led to an easing in UK domestic inflationary pressures. But unfortunately, just as that easing was taking place, we were hit by another phenomenon, the Russian invasion of Ukraine, which had very profound implications for the prices of energy and the price of food. So this chart, I think, is quite telling. The dotted lines show the price of oil in the US and in Europe. That increased a little, as you can see, but pretty modestly through the invasion. But crucially, in some sense, the US and European prices moved in lockstep. By contrast, when we look at gas, gas is less tradable because it runs through pipelines. There was more separation. The US price of natural gas did rise, but remained overall in a relatively well-behaved way. But there was a dramatic and unprecedented rise in the European prices of natural gas. They not only rose very, very significantly to a peak which was almost exactly a year ago, where they were almost at an equivalent of $600 per barrel in terms of oil prices, but they also became very, very volatile, as you can see in this picture. And that volatility made forecasting and communication about the inflation outlook quite challenging. And interestingly, the UK is particularly exposed to this increase in gas prices because, as a result of choices made in the past, the UK is a country that is particularly dependent on natural gas, both as a way of heating houses and also of generating electricity. So, of course, the combination first of this constraint on international goods prices and then the implications of the invasion and its impact on energy and food prices led to a dramatic rise in UK inflation, which peaked at over 11% on the headline measure, and led to, as you can see on the right-hand side, inflation outturns being well above what the Bank of England had forecast in the form of its famous fan charts. The bank is often criticized for these fan charts being too wide. Of course, they're intended to reflect the difficulty of forecasting, but as you can see, we had a width of the fan chart which is somewhere between 4 and 6 percentage points. And yet, despite the width of that fan chart, the outturns over the past year have not only been above what we forecast, but they've been persistently above what we forecast. And if you look at the left-hand panel here, you can see that although headline CPI inflation has now declined as the energy prices and particularly natural gas prices have eased, it's nonetheless still the case that core inflation remains stubbornly high and as yet doesn't show an obvious downward trend. So what does that tell us? Well, I think that tells us something about the dangers of second round effects, the issue that Chris allowed us to talk about. The rise in headline inflation, the overshoot of inflation, was largely associated with direct effects coming from energy prices. Utility bills, which enter the CPI index directly, rose very significantly. A large part of the initial rise in core inflation reflected the indirect effects of those energy and food price rises. For example, restaurant prices would rise because the cost of food and the cost of utility bills to cook that food and heat the restaurant increased. But the stubbornly high level of core inflation, even as energy prices have eased, is likely to be symptomatic, at least in part, of these infamous second round effects and the danger that some of the inflationary dynamics are becoming embedded in pricing and wage and cost-setting behavior in the UK economy, which lends to precisely that persistence of inflation that monetary policy needs to address and turn around. So I think it's important that we draw a distinction, as I did in a talk I gave earlier in the year in Geneva, between what you might call extrinsic persistence of inflation remaining high because there's been a sequence of external inflationary shocks, one after another, that all go in the same direction, which is a little bit of a narrative saying, how unlucky can you be to have this series of inflation shocks pushing you away from target, versus an intrinsic persistence in inflation, which reflects the fact that there may be changed behavior in the economy, which is leading to an embeddedness of greater inflation in price and wage setting dynamics. And I think it's that question, how much of that, how much firms and households try and defend their levels of real income in the face of these rises in external costs, that I think is sort of the key question now in the UK economy. And what I think is important to see here is that it may be that we see behaviors that are non-linear. As inflation rises, maybe wages rise in order to try and catch up and maintain the standard of living. That's a point that Raphael was making. And there may be reasons when we have a tight labor market that tendency to catch up is more accentuated. And the UK has had a tight labor market of late, as I'll come to. But I think that of itself does not necessarily lend persistence to inflation, because as the labor market eases and inflation starts to fall, one would expect wage growth to come down. So it might lead to greater sensitivity to the underlying cost shocks, but doesn't necessarily lead to greater persistence inflation if those cost shocks eventually unwind and then go in the other direction. So in order to see that persistence, what we need to see is not just nonlinearities, we need to see asymmetries in the response of wage, cost, and price setting to these external shocks. And I think that is the sort of key question that I want to get to is, can we understand in real time whether there's evidence of these asymmetries in price setting behavior? So that brings us to the question of how can we try and establish that type of evidence. If we wait until we have the full set of data, given the lags in transmission of monetary policy, we will have waited too long. We will be behind the curve. So what evidence can we extract in real time in order to do that? So a little bit in the same spirit of remarks Raphael was making, and indeed I think we interact with some of his colleagues on these surveys, we do ask corporates about what their pricing behavior is, and then we try and understand whether that can give us some insight. So let me sort of just go into a little bit more detail into sort of two questions here. What this chart shows is the very strong historical correlation between developments in producer prices in the manufacturing sector and core goods prices, which are part of the consumer price index. And if you look back through history, these two series move very, very closely together. But if you look in recent months, a big gap has opened up. Producer prices have fallen, producer price inflation have fallen very significantly in line with global developments, as you'd expect for goods that are very, very heavily traded. But the component of core goods in consumer price inflation has remained stubbornly high. So there's two interpretations of this chart. One interpretation would say, well, ultimately that historical correlation will reassert itself and core goods inflation in the consumer price index is set to fall relatively rapidly. An alternative interpretation would be there has been some change in the pricing behavior relative to historical experience in the UK domestic market, which is leading to greater embeddedness of inflationary pressures within the UK. And of course, just by looking at that chart, you cannot distinguish those two hypotheses. So what have we done? Well, we have a survey called the Decision Maker Panel, where we ask about 9,000 UK firms how they are engaging in business on various dimensions, including in what they're doing on pricing. So we have asked them how frequently are they resetting prices. And as you can see from this chart, in the face of the significant cost challenges of the last few years, firms in the UK have tended to change prices more frequently. So back in 2019, roughly half UK firms were changing prices only once a year. But in the face of these shocks and these disturbances we've seen in recent years, that number has fallen to around about a third, with most of the firms, almost all the firms, moving to changing prices more frequently. That is consistent with the view that firms are moving away from just changing prices on a time-dependent basis once a year to changing prices on what you might call a state-dependent basis. As cost pressures change, they have to change prices as they go along in order to maintain margins and so forth. And what we also find from our surveys is that those firms that price on a state-dependent basis, as you might expect, they tend to be more sensitive to, in terms of how much they increase their prices, as cost pressures increase. So if we're seeing firms move from being time-dependent to being more state-dependent, and in the state-dependent environment being more sensitive to higher costs, as costs have increased, and that's certainly been the case since the end of 2020, what we've seen is that state-dependent firms have tended to have higher rates of inflation reported in their responses to the survey than time-dependent firms. So that would account for the fact that we see a greater response of inflation in aggregate because more firms are moving into a world where they're responding in a way that pushes inflation up. So that's a description of the past. That's a non-linearity. That would suggest that the sensitivity of prices to cost shocks, if you like, the slope of the price Phillips curve in the UK, has become steeper of late. Now, there is some good news, nonetheless, which is that if we ask those state-dependent firms what they expect inflation to be next year, as you can see in the chart, the red dot is below the blue dot. State-dependent pricing firms think inflation will be lower next year than it is relative to what time-dependent pricing firms suggest. And that would be consistent with the idea that, yes, there may be a non-linearity in pricing, but it's not necessarily an asymmetry. Those firms that have raised prices more aggressively as cost pressures increased may also reduce prices more significantly as cost pressures recede. Now, I don't think we should be complacent about that. We're still talking about rates of inflation that are anticipated in the 5 to 6 percentage point range, which is clearly not consistent with our target. But it does suggest that the asymmetries may not be as acute as the most difficult type of environment would suggest. Now, you can show a very similar picture looking at the labor market. And in the labor market, what we have seen in the past is a similarly close relationship between the official series for wage growth, the so-called average weekly earnings, or AWE series, that's the blue line here, and a forward-looking indicator which surveys firms and asks them how they are setting wages. So as you can see, a little bit similar to the picture for core goods, if previous historical relationships remain in place, that forward-looking indicator, the orange line, would suggest that monetary policy is working. After a period of very tight labor markets associated with strong wage growth, we are seeing vacancies fall, the ratio of vacancies to unemployment weaken, albeit still at relatively high levels by historical standards, but nonetheless easing to where we've been in the past. And as a result, there is an anticipation that new hires, which is what's reflected in the orange line, will see slower wage growth in the past. And yet, as that orange line has declined, nonetheless, in recent months, we've seen official wage growth increase. So there is a paradox here. It can be resolved in two ways, just like the other paradox. One reading of this chart is that historical correlation will reassert itself. We'll see wage growth weaken in line with the forward-looking indicator, and that will bring wage growth lower, services inflation down, and help us return to target. An alternative view would be there is a change in this behavior, and that would be more worrying, that gap is indicative of a breakdown in historical relationships. Now, again, in real time, we cannot distinguish between those two things. I think, though, we are thinking very closely about why that gap may have emerged. And one thing that's a feature here is that the new hires data reflected in the orange line may reflect the sort of marginal hiring decision, whereas the strength of average wages reflected in the blue line may suggest that after a period where recruiting difficulties have been acute in a tight labor market, firms are wanting to hoard labor rather than shed it at a time where the economy is weakening. And as a result, insiders, incumbents, are being better paid than people at the margin in terms of wage growth. And so a sort of key question for us is whether that labor hoarding will continue and support wage growth and cost growth, or whether we will see a further easing in the labor market which tends to operate against that and allow this historical correlation to reassert itself. And as you can see, this is a sort of expression of the wage Phillips curve. If you were just to look at recent few years, you would see that there's been a significant steepening in the wage Phillips curve. Wage growth has been significantly stronger than you might have expected given the decline in unemployment. Part of that may reflect these convexities that I was talking about earlier, but a very important open question to us is that steepening something that's permanent, or is that something that's going to allow us to be stuck at higher rates of inflation going forward? And that is a key question for our monetary policy. Now, if you think about what we've done here, is we've looked at monetary policy and tried to extract information from the dispersion of developments across prices across firms and wage growth across sectors and firms. So I think a kind of important open question for us is whether we can use information on this cross-section to help us inform about what's going on with inflation through time. What's important to us is the persistent component of inflation that by nature is a sort of slow-moving time series concept in the aggregate macroeconomic data. And where we've got more information is in the cross-section bottom-up firm-by-firm behavior. So a sort of key question for us is how we can marry those two things together, how much that cross-sectional variation in the surveys tells us about the time series dynamics. So if that's what's going on with inflation developments, I just want to conclude with a few remarks about what's going on with monetary policy transmission. So this is an estimate of the standard transmission mechanism in the UK, made using data up to 2019. Reassuringly, it has the patterns you'd expect. A monetary policy tightening weighs on price developments, restrains activity and employment, and leads to an appreciation of the exchange rate. I think a couple of things I would pick out here are, first, just to note that the developments in the CPI here are in the level of the CPI. So if you look at inflation, you're looking at the slope of this curve. And the slope of this curve is steepest or most downward. The inflation rate, the maximal impact of inflation, is after about 10 months, rather than the sort of 18 to 24 months that we normally think of as being the sort of typical biggest, where the lag at which the biggest contribution of monetary policy to constraining inflation takes place. But I think what's important to see is that that is associated with quite a sharp appreciation of the sterling exchange rate. So to the extent we see stronger and quicker impacts on inflation, it's in large part because of developments in the exchange rate, which is a sort of small open economy story. One of the features of the last couple of years has been that this is an exercise which says if the UK tightens monetary policy independently and everyone else and everything else stays the same, what would happen? Of course, over the last 22 years or so, we've seen a global shock to inflation so that everybody is moving interest rates together, and that's mitigated some of this exchange rate effect. So the impact of monetary policy on inflation in the UK has a little bit lacked some of this exchange rate dynamic. That's put more weight on the restraint on activity and employment, and that means probably the lags in transmission are indeed more in the 18 to 24 month range, as historically we have seen. I won't, in the interest of time, talk about things to do with developments in the housing market, but I do just want to conclude with a few remarks on exchange rate pass-through. So one of the things that we've been doing is, if we're looking to try and distinguish developments in whether cost pressures have a non-linear or an asymmetric impact on inflation, we haven't had experience of that over the last 25 years of inflation targeting, where inflation has been very well behaved. But what we have seen in the UK is quite significant movements in the exchange rate. And we can sort of use that as a proxy to think about, has there been asymmetries or non-linearities in the pass-through of exchange rate increases into the price level? So if you exploit that cross-sectional variation and you try and see, if you look across sectors, you will not be able to read the different sectors here, but across sectors, there's a lot of differentiation by sector about how strong exchange rate pass-through is. And indeed, if you look at certain sectors, you can see that there are quite strong asymmetries in how exchange rate pass-through takes place across sectors. So some sectors respond more to depreciations than they do to appreciations. This is a rolling estimate of the extent of exchange rate pass-through. And when the sterling is appreciating, some of these sectors show high levels of pass-through in contrast where exchange rate is depreciating. But I think the interesting thing is that despite that suggestion of asymmetry at the sectoral level, when we look in aggregate, and just to emphasize, it's that the aggregate macroeconomic level that matters most for monetary policy, while there is some evidence of nonlinearities, as we've seen in the pass-through of costs, that big depreciations or big appreciations tend to have bigger effects in bigger amounts of pass-through than smaller ones, as one might expect, there's much less evidence at the aggregate level of asymmetry. So depreciations and appreciations tend to lead to the same overall level of pass-through. And I think, again, that's something that we can draw some comfort from, is that if it's asymmetries in the behavior that lead to persistence in inflation, the experience with exchange rate developments in the past, if cast into the space of cost developments today, I think that gives us some hope that just as inflation rose strongly in the face of these sharp cost rises, as those cost rises ease and reverse, then we can expect to see a decline in inflation, which will serve us to get back to 2%. So let me just conclude quickly by saying a little bit in the spirit of Raphael, what does all this mean for policy? In its last monetary policy report, the MPC published two scenarios for the inflation outlook, one based on a path of interest rates that was embedded in market pricing, which saw bank rate, the policy rate in the UK, rise above 6% next year and then fall to about 4.5% in the middle of 2026, so a sort of hump-shaped path of interest rates. And that led to an outlook for inflation that looks like this. Now, it also produced the scenario where bank rate was held constant at the level it is today of 5.25%. And if you look at these two pictures, they're basically indistinguishable. So there are two sort of paths which both achieve an outlook for inflation, which is perhaps a little below target, but broadly speaking in line with the 2% inflation objective. And I think that brings me back to why it's useful to be in Cape Town, and I think it goes to some of the remarks that Raphael was saying, is that there may be multiple paths that get you to where you want to be. Some of them have a more rise rapidly and then fall rapidly, what we sometimes call the Matterhorn profile of interest rates on the left-hand side. But an alternative one would be to hold restriction in policy for longer, but in a more steady and what Raphael described as resolute way, with a profile for interest rates that looks a little bit more like Table Mountain. And I think that is a big part of where the debate about monetary policy is today. And I think consistently with remarks Raphael made, I think I would tend to favor the latter. I think it probably imposes fewer risks to financial stability. I think it's more of a response to trying to squeeze inflation out of the wage, price, and cost-setting system. And crucially, I think in the UK, it's more effective at ensuring that we see transmission through the sort of 2 to 5 year maturity rates that have become very central to the way the mortgage market and private borrowing operates in the UK. So that transmission from policy rates to medium-term maturity rates is more important, and I think that's likely to be supported by this type of resolute profile rather than the spike profile. So sorry for overrunning a little bit, and let me stop there.
So while they upload my slides, let me thank the governor and the organizer for the wonderful opportunity to join what promises to be a topical and thought-provoking conference. And also let me apologize with the organizer for being slightly out of reach in the past couple of weeks, let's say, because I joined an anti-poaching team in Limpopo, which tells you how much I love this country, but also explains my terrible haircut at the moment. So if I can get my slides, perhaps, and I will stop talking about how I spent my summer holidays, and I'll move to the topic I should discuss about, which is the post-pandemic inflation in the euro area. and I will compare that to the US. I won't have much to add to what President Bostic said, apart from perhaps towards the end a little thought, a little provocation. Now, when we look at euro area inflation, there is what I would call it out of a simplification, the dominant view. And the dominant view for the euro area inflation is that inflation in the euro area and in the US has essentially the same cause, excess demand, private excess demand and government excess demand through stimulation, both on the fiscal side and on the monetary policy side. And that goes with the understanding that there were large policy mistakes from the Fed and the ECB, and those were often referred to as due to group thinking, basically. And that arcs back to the debate about transitory versus permanent inflation, but also to table forecasts from the central banks. And on top of that, there's been the activation of a lot of nonlinearities in the economy. The Phillips curve was thought to be flat and then steepened all of a sudden. Monetary policy transmission changed, labor market showed nonlinear effects, and so on and so forth. And this is a view that has been expressed many times, also by the IMF more recently. And against this background, policy mistakes, slow response, bad focus, there was a high risk of the anchoring of expectations and a wage price spiral. So that's what I will refer as a dominant view. And let me go straight to the point so you will see the line of my argument. I will argue against this view. My presentation will argue that while in the US there are good reasons to believe that inflation was caused by excess demand, in 2020 the disposable income of US consumers increased by 6.2%. That's an incredible boost in the middle of the pandemic. There are not good reasons to believe the same for the euro area. And in fact, in 2020, disposable income for the euro area consumers contracted 0.6%. And in fact, what I believe is the story for the euro area is essentially the effect of the large energy supply shocks that was caused by the invasion of Ukraine by Russia, and partly spillover effects due to excessive global demand, especially from the US, clashing against the tightness of supply chains and dislocation of supply chains post-pandemic. I will also argue that we don't need to invoke lots of nonlinearities. Especially, we should not invoke lots of nonlinearities based on very few data points. And we should not hide behind nonlinearities what is clearly an incomplete understanding of the economy we have at this point as both academic and policy maker economist. I will then try and argue that the delay in response for the euro area was due mainly to the incomplete framework of which euro area suffers at the moment, with a single central bank, but many policymakers and fiscal policymakers, and I'll try and be more clear about that. Where in US, I will try and push the argument, perhaps the flat Phillips curvist won the argument before the pandemic, and that sort of idea of a flat Phillips curve came back with a revenge when there was excessive demand in the US. And I'll also try and convince you that the risks of the anchoring and price-wage spiral didn't materialize. They were very plausible, of course, but they didn't materialize, while at the moment there is a risk of earth tightening for the euro area. And then I will have some thoughts about the future of central banking if time allows. So let me show quickly how inflation in the euro area and in the US look like. And in the case of the euro area, the last readings for HICP, harmonized index of consumer prices, is 5.3, and for core is 5.5, well above the 2% target, with core showing to be very sticky, albeit to be known to be a lagging indicator, if you want, of prices instead of a leading indicator for HICP. The last readings from yesterday for Germany are 6.4% for HICP, 5.4% to core, beating up essentially the forecast of the market, and that might sort of let people think that there will be a further tightening in the euro area monetary policy. And against this background of of a high surge of inflation and its stickiness, we know that the policy stance tightened. Let me apologize for the dates that are wrong on the first chart. My spreadsheet on my Mac suffers of some bug I couldn't fix. But as you can see, the policy stance moved with a delay, especially in the euro area, against the surge of inflation, and then shoot up. In the case of the euro area, the current deposit rate is 3.75%, with a 425 basis point increase from negative territory after the pandemic. And there's also a shrinking of the balance sheet because the APP, the QE program for the euro area, and the long-term refinancing operations are coming to an end, and there is repayments coming through, and the end of the reinvestment of the APP program. So it's an overall aggressive stance of the ECB, pretty much in line with what is happening in the US. But now let me try and convince you that in the case of the euro area, we cannot think of a demand story. And here I'm comparing GDP on the left for the euro area with GDP on the right for the US, scaled to 100 just before the pandemic. And while in the case of the US, you see that basically there is growth in GDP, in the case of the euro area, it flatlined pretty much and didn't go back to the trend. I'm not plotting a trend, but if you think about the trend roughly of growth of 1.2%, that would be below trend. So in the aggregate, it doesn't seem to be excess demand or a very exuberant economy. And if you look at components, you see that in the case of the euro area, and differently from the US, both investment and private consumptions are subdued, while there is a bit of government consumption. In the case of the US, what is not shown here is the transfers during the pandemic that created a lot of disposable income, and that showed up in consumption. So overall, in the case of the euro area, it's hard to pin down from GDP and its component excess demand. And if you look at import and export, it's the same picture. In the case of the euro area, there's quite a bit of export going back to trend, while import is subdued, and that's the opposite of the US. And that shows the difference in the role of internal demand towards import and export. So I would say just a cursory analysis of these charts would makes us think that perhaps there is not excess demand in the euro area. When you look at the labor market, again, if we just look at total hours and employment, the US and euro area look the same. Employment is growing fast. There's a hot labor market. However, if you look at average hours, the gray line, you see that average hours didn't recover from pre-pandemic levels in the case of the euro area, while remained essentially unchanged for the US. And that points to very different labor market dynamics, where shifts in behavior, perhaps labor hoarding, perhaps long COVID effects are essentially increasing total hours and employment, but not average hours. The average worker works less in the euro area. And there's a compensation, if you want, on the extensive margin. Now, what is the policy problem in the euro area, and why is it different from the United States? So let me just remind us how the euro area is different from the US. Well, first of all, the ECB has a single mandate. It's price stability. So in principle, you might think that there might be a tightness bias because you don't need to take into account a growth consideration. On the other hand, however, there's one central bank, but many fiscal policy makers. And this makes the monetary policy problem very complicated because there is not a single yield curve. Sometimes we use the OIS as a proxy for that, but there are many country yield curves, the sovereign yield curves. And that makes for potentially uneven transmission of the policy stance and potential fragmentation risks. Or, in the worst case, the kind of self-fulfilling crisis we saw about to happen during the euro area sovereign crisis. This very peculiar setting delayed the response of the ECB because there was a need of finding an agreement before hiking rates to create some instrument to guarantee an even transmission of policy stance during tightening. And that is what came about to be the TPI, the Transmission Protection Instrument. This is not a completely neutral instrument. There's a debate to be had because it has the flavor of a quasi-fiscal measure. But that agreement allowed the ECB to move forward, but also delayed the response of the ECB. Now, what is the problem of the ECB in terms of inflation? We'll argue is about price and energy price shocks. And here I'm borrowing a chart from the Geneva Report 2023, and I'm comparing where they are comparing on the right panel, the increase in oil prices, in gas prices in recent years with historical movement in energy prices. And as you can see, the increase of 200% year-on-year of gas prices in Europe compares quite impressively with the peak of the great inflation in the 70s for oil prices. Now, my argument will be that these large energy price shocks has to transmit in European economies and will take time to transmit and to dissipate. And what we are looking at the moment is the dissipation of this large shock that was clearly caused by the Russian invasion of Ukraine. What complicates the response of the euro area is also the fact that the euro area is a net importer, differently from the US, of energy commodities. And that explains the widening gap in terms of trade index between US and euro area. The increase in energy prices worsen the terms of trade and makes the ECB potentially more inclined to tighten in order to stabilize exchange rate vis-à-vis dollar. Of course, this is not an official motivation, cannot be, but perhaps in the back of the mind of the policymaker there is some thought about this. Now, if you think about the risks we were mentioning before, the anchoring of expectations and price-wage spiral, they didn't really materialize. This is a recent chart and shows you how well anchored are professional expectations. And if you look at consumer expectations, they're not too different. They're more volatile, of course. And there's a short-run sort of understanding in this survey of the fact that the shock will take time to dissipate and then eventually will reconverge back to target. You might think of this as essentially a bonus of credibility the ECB and also the Fed gained over time that allows for policy space to our central banks. In the same way, the price-wage spiral did not materialize. Actually, if you look at real wages, workers took a hit, a quite large one in real terms, and only in 2025 the ECB would expect wages to go back in real terms to where they were. And again, this talks about the dissipation. And also the ECB wage tracker does not show risks of a price-wage spiral, albeit the last wage indicators for Germany came out at 6.6% above inflation levels. There was news of a couple of days ago, but probably they due to temporary measures as the increase in minimum wage and some bonuses. Now, let's look at the transmission. We saw that there's been a very aggressive tightening of the stance in the euro area, and that has transmitted to lending rates from banks to both consumers and firms in line with what we would expect from a normal transmission of monetary policy. So the next natural question is how long it will take for these measures to affect the real economy, to to reduce prices, in particular core. So let me show you some recent work I've been doing on the effects of monetary policy in the euro area. And here I'm using some measures of monetary policy prices that Raphael Kganyago and co-authors have collected, and we are using them and twitching them in order to take out some component. I won't be too technical, but basically, when you look at the blue line, that are the effects of pure monetary policy shocks. When you remove the information effects, it is the communication of the central bank about economic conditions, and when you remove country risks shocks. So let me show you how they look like. This is a tightening of 100 basis points on the OIS 1-year rate, and following this tightening, I will focus on prices. You see that the GDP deflator starts contracting, and that's also true for core inflation for the euro area and for different measures of HICP. And all of them shows a quite slow decline with, peaks effects probably on a 2-year horizon. So that talks about a slow sort of time frame for these effects. So in a way, we will be dealing with the effects of tightening a long time after the tightening will have came back. And these lags in the response of monetary policy should be considered, I would say, especially given the fact that there's also QT happening in the euro area, and again, the effects are very similar, with very persistent effect on core, the GDP deflator, HICP, and with max effect on a 24-month horizon, again, 2 years. This essentially has to be factored in because risk to growth might materialize. At the moment, growth indicators are incredibly weak in the euro area. The last reading for PMIs was negative, indicating potentially a recession risk for the euro area, with the aggregate manufacturing services PMI at 48.9 value, so below 50, and with the lags in the effects on monetary policy. I was not showing you the real effects on industrial production or GDP, but they come with a lag. And that might point to growth risks at the moment for the euro area. Let me, in the last few minutes, conclude with two different arguments. The first one is about group thinking and policy mistakes. Now, one of the potential policy mistakes of the Fed, I will argue, comes from a misjudgment potentially of the Phillips curve, the flatness of the Phillips curve argument. And here I'm taking some charts from a recent work of mine that with Lucrezia Reiklin and Lapobini, that follows up on a previous work a few years ago that has been recently published with a different group of co-authors. And what I'm showing you in the first chart, or the top chart, is essentially a measure of the output gap for the US in blue from a model. It's a quite sophisticated model with many variables, but essentially extracts a measure of the output gap using many indicators of labor market and real variables and nominal variables that comes out from the model against the estimates for the CBO and the Green Book, the Fed. As you can see, they go in line for most of the sample from the 60s onwards, but then diverge after the Great Recession, with the official estimates showing a very large output gap. Now, the consequences of assuming a very large output gap is that you then have to assume a very flat Phillips curve. Now, models of the type I'm using here instead were pointing to a different story in which the output gap was much smaller and the Phillips curve didn't change much. And in fact, as you can see in the bottom chart, that's the decomposition of CPI of the trend, of the 2% trend, and the blue line is the reflection of the slack in the economy, the output gap into prices, while the red line, the red part, are the effects of essentially oil shocks, energy price shocks. Now, once you are able to clean the energy effects from CPI, you see that there is quite a strong Phillips curve component, and you might also wonder how stable is this Phillips curve. And if you go through samples, you see that it's fairly stable indeed. So I would argue that perhaps one of the policy mistakes came from an underestimation of the steepness of the Phillips curve in recent years. And perhaps a more open academic debate would have allowed to weight different sides of this argument. Using the same model, you might wonder whether monetary policy should respond to energy price shocks, and this is just an historical response in a way, because I'm showing you for the same model how the federal funds rate would look like. And what we find is that the federal funds rate responds historically only to output gap and not much to energy price shocks. So there is a kind of a regularity by which the Fed has not responded to supply shocks, has been essentially looking through supply shocks. Also because the frequency at which they happen is much higher than the frequency at which the effects of monetary policy will materialize. So perhaps there is a strong argument there. But of course we need more research on that, how monetary policy should respond to supply shocks. There are exciting new papers coming out. There's a new paper from Silvana Ternero and co-author on that. Let me conclude in the last 3 minutes I have about the future of central banking. I won't say too much. I just want to make a couple of perhaps remarks. The first remark is that if you think about the response of the euro area to energy price shocks, you have to wonder whether that can be the blueprint for the future. And the future might look like as a sequence of very volatile and very large supply shocks. This is a chart taken from the US Space Agency. There are very similar charts from Copernicus, the European mission, and shows the anomaly in terms of temperature for July 2023. That is the hottest month on record since 1888. That is, since we have records about temperature. Now, we cannot think that such large deviations will not affect food production, energy production. Think about renewable sources from water, but also nuclear sources that require water, and so on and so forth. That might create serious supply shocks, and the question is how a central bank should deal with these potentially large shocks. So to conclude, the question is whether we are becoming submerging markets. In a way, there was submerging markets was coined, I think, for the UK in recent times, but increasingly advanced economies look like emerging economies in the sense that they are faced with large shocks and very volatile economy, large compared to the ability of the economy to absorb smoothly these shocks. And there's a long list potentially of these shocks, geopolitical tensions. We talked about the war, climate and ecological risks coming from green transition, pandemics, you name them, aliens. And against this sort of background, the central banks seem to be running out of good luck, if you think about the old argument of good policies versus good luck. And good policies are indeed harder to define today, with a mandate that is increasingly difficult to achieve. Now, people from emerging markets know well what that means, I believe. And there are difficult trade-offs to square. And I think there are important lessons from emerging markets, both in terms of what policies do not work and perhaps in terms of which policy could work. So in terms of a path forward, I think we need a more open, less centralized academic debate. I think it's too centralized around very few centers in the US. I don't think it's a healthy state of the debate. We need more humility and clarity in defining policy objective, and perhaps a nuanced view of what can be achieved indeed. Now let me conclude with this one. There was a time where on the website of the central banks, the ECB, San Francisco Fed, a few more, there were simple games where you could learn to be the chair of the central bank. And the idea was that central bank was an easy game, it was a kid's game. Inflation was going up, you were hiking rates, and that was it. Now all of these games have been taken offline recently. So central bank is not anymore a kid's game.
We have just under half an hour for questions, and as you can see, the three presentations are characterized by similarities and differences with different geographical area, more or less UK, EU, and the United States. So let me take clusters of questions, and then I'll get the panel to respond. We also have questions. We also have people on Zoom, so we'll first look at questions in the room and then move on to Zoom. So who wants to kick off? JF, we can always count on JF to kick off.
Thank you, Chair, and thank you to the panelists. From the way some of the situation has been presented, we seem to be getting in the US some nice disinflation with still a bit of growth, whereas in Eurozone or the UK, it's a bit the reverse. Core inflation has started to decline, and growth is, in some cases, not that strong. So is it just a matter of lags, or is it because of the terms of trade, as a previous chart was showing, that Europe suffered the negative terms of trade shocks, unlike the US? Or is it a sign that maybe the US economy is displaying more flexibility to shocks and returning to a more normal situation earlier? I mean, it would be interesting to understand. The other question I thought of when looking at one of the charts was this goods versus services consumption. A lot of people are talking about the rotation back to services consumption, but it seems to have stopped. It seems that goods consumption is structurally higher as a share of total consumption, and we see the same in the US. So I'm just wondering, is there something that's happened, in consumer patterns, spending patterns that we might not have fully grasped?
Okay, we'll take clusters of 3 or 4 questions. So that is Jean-Francois from the Reserve Bank. Please introduce yourself, Research Department. I have a question there, and then I have a question.
Me to think people know me.
And I have a question there. So I'll take 3 questions, and then we'll David, go ahead.
Great, thanks, Rashad. I'm David Folks, also from the Saab, also a person after JF who you can rely on for a question. President Bostic, I want to ask how you think about the broad macro stance in the US. A very compelling case that monetary policy has got a foot on the brake, no question. But where does fiscal policy come into this? It's always very difficult for central bankers to talk about fiscal policy, so I'd really like to hear how you describe, it seems to me there's a foot on the accelerator for fiscal policy, and I'd like to know how you think through that. Thank you.
We have a question there. Yep.
Thank you very much. And thank you for for inviting Bank of Tanzania.
Please introduce yourself.
Yes, my name is Yamunka Ndabila, Deputy Governor, Bank of Tanzania. Yes, I also wanted maybe to hear from presenters whether, given the presentations, whether central banks have enough tools really to fight what the shocks are now, giving us. That is number one. Number two, of course, I wanted to ask whether we see a return of fiscal dominance. Thank you.
Thank you. Yeah.
Ina Hewitt from ABSA. I just wanted to find out how worried you are about financial stability risks and the contagion thereof globally, and where you think it might stem from.
Okay, why don't we kick off with you, Raphael, and we can. You kick off? Yeah. Okay. Let's go. Yeah.
So, well, thank you very much. This is working, right?
Yeah.
So, I think in response to the first question, I'll just go through the questions quickly. In response to the first question, I think you kind of answered the question yourself. I would very much agree that Europe has faced a different combination of shocks. And I think a key element of that was the Russian invasion of Ukraine and its impact on commodity prices, which was both differential in Europe. So natural gas prices in Europe rose very significantly. And I think the quantum of that increase has not really been fully recognized in the global macro debate that I see. So we're talking about an increase, as I said, if we think about it in terms of the energy equivalent, in terms expressed as the dollar price of oil, of going close to $600 per barrel. And that is comparable to the magnitude of the shock we saw in the early 1970s. So the magnitude of the shock there was very significant. The volatility around that was also very significant, which made practical forecasting operational questions more difficult. And crucially, and as also a number of us have said, and as you said yourself, for Europe, for most countries in Europe at least, that was a terms of trade shock, a deterioration in the terms of trade. So this squeezed national income, and that weighed on domestic spending power. And I think crucially, and this is an important part of the UK experience, is that squeeze on domestic national income, there has been a tendency to resist that, and both in terms of price setting and wage setting, we have seen the attempts to resist that squeeze on spending power associated with the deterioration in the terms of trade. That's one of the drivers of this threat of greater persistence and embeddedness within the inflation process.
Just trying to keep it a bit closer. I'm not sure whether the problem is on your side or the other side. Yeah. Yeah.
It's going in and out.
Yeah. Thanks.
I think I'll leave the question on fiscal policy in the US to Raphael, of course, but I do think that
you can feel free to answer it if you want.
I think when we talk a little bit about do central banks have enough tools, I think it's very important that monetary policy recognizes that monetary policymakers recognize they're responsible for a potentially very powerful tool. So monetary policy can and has had big effects, but it's also a very blunt tool. So monetary policy is not an effective tool to solve all of the challenges that we face. In fact, at least over the medium term, it's really only effective in addressing one challenge that we face, which is to return to price stability. And I think, sorry, is that better? Okay. So, and I think it goes a little bit to the point Giovanni was making around having clarity of objectives and focus of tools. Of course, central banks, for example, the Bank of England, we're responsible for other things in payments, we're responsible for things in supervision. And those should be focused on where, but I do think that clarity of a potentially very powerful tool, but a blunt tool, and recognizing that monetary policy cannot address or solve all problems, and it can't micromanage the lags in transmission, the variability in those lags, means that ensuring inflation or steering inflation at a very high frequency, month-to-month basis is not feasible or desirable. But I think ensuring that that's oriented towards maintaining price stability over the medium term, which in our case means inflation at the 2% target on a lasting and sustainable basis, I think that has to be the sort of key element there. I think on financial stability issues, I think that is a distinct thing. What we have seen is there has been an accumulation, I think, of risks through a long period of low rates and easy liquidity. And the fact that assumptions were made about the flatness of the Phillips curve and the death of inflation and so forth perhaps led some neglect, at least in segments of the private sector, segments of the financial sector, about the risks that might have been entailed by higher inflation and higher short-term interest rates. I think we've seen the manifestation of that in some cases. And I think that is a reason why maintaining the focus of monetary policy on price stability and trying to have steady, resolute, predictable evolution of monetary policy rather than introducing greater volatility and surprises through monetary policy changes seems to me to be very important.
Yeah, Raphael?
Yeah, so am I working?
Yeah, you good.
Okay. So first, thank you for both your presentations. They were both very much appreciated, and I would agree that central banking is not a game. So it is not a child's game, and it's something that really needs to be taken seriously. Let me think about these back to front. So in terms of financial stability risks, so I often say I get paid to worry, so I'm always worried about risks. And these risks are significant, they're always there, and we have to think about it. I think how I'm thinking about financial stability today, there are really two components to it. One is just the overarching strength of the banking system, and to what extent do institutions have enough capital? Are they doing the appropriate risk assessment and management? And what we learned in the great financial crisis was that they didn't have enough capital. In the US, we've really taken steps to try to have them have considerably more. And to date, they seem to be in a reasonable place. Now, I will say, in this pandemic crisis, the amount of capital was not tested as much as it might have been, because in our country, the fiscal response was considerable. And so the stresses to the banking system didn't realize in a way that we thought they might at the beginning of the episode. And I'm grateful for that, but it means that there are still questions about and the need to be very concerned and monitor very closely on those things. The second piece to this, though, is how do we think about risk? How do we think about the transmission of challenge in this new period and our collective readiness for it? And when I think about Silicon Valley Bank, that bank died 36 hours after a point where no one thought it was even a problem, right? So Thursday morning, no one had it on the radar. Friday noon, it was gone. That has significant implications for how we think about what a bank run can look like, how we think about preparation for and management of interest rate and liquidity risk, which many thought was no longer on the table. And it has implications for how technology has changed how banking happens, how capital and deposits flow, and all those sorts of things. That raises questions for me about our internal processes of supervision and regulation, how quickly we need to identify a challenge, how nimble we are in terms of our responses. All those sorts of things need to be examined. And I would say for me, I got a whole new appreciation of how the world could work. And it shook me for quite a bit to say, I got to talk to all of my banks differently. I've got to talk to my examiners and have them be much more front forward. And we have to be much more open to the possibilities that technology has introduced. A second dimension to this, which we also talk about quite a bit in my building, is that there are many people in banking today who have never lived through a higher interest rate or rising interest rate environment. And that lack of experience also exposes risks in ways that we actually need to be thoughtful about and how this is going to play out. And we're starting to have those conversations as well. In terms of the question of fiscal dominance, I agree with Huw on this. We actually have a different charge, and a very specific charge, which is really about, as I think about it, creating a foundation for longer run decision making and investments to be made in their maximal way. And in many regards, fiscal policy is going to have a large component of addressing some of the short run immediate challenges, as well as specific infrastructure investments. You think about inflation or roads or those sorts of things that are going to help the economy perform as well. For our bank, I've really told our folks to take fiscal policy as given. We're going to just take that as an input to our consideration of what's necessary. And what I would say is that sometimes it makes our job more straightforward. Sometimes it makes it more challenging as the circumstances prevail. I'm grateful in our country that we had a fiscal response that prevented the worst of the worst from happening. You know, all the projections were there were going to be millions of jobs lost forever. Small businesses were going to fail all over the place. People were going to lose their homes and be on the street and really desperate. And we didn't have all that. So I think that has actually, in some regards, made our policy decisions easier because we didn't have that kind of difficulty, but harder because partially a result of that was this high inflation that we are now trying to take under and get under control, and we're going to get that under control, and that's really important. And then on sort of the goods versus services, and the first two questions I think kind of relate to each other. The U.S. Was not as exposed to the energy shocks. I've been looking at a lot of slides from some of my colleagues from around the globe, and it is really striking the impact of energy and sort of the orders of magnitude difference in the impacts in the U.S. relative to other places, much, much lower in the U.S. We produce a lot of energy on our own, and that puts a sort of an upper bound on how much volatility we're going to have in those sorts of things. And then I also think that the way our economy, we are much more internally contained. We're a very large economy. Almost 70% of our GDP is our own internal consumption. That also puts some boundaries on how much volatility we're going to see in these global circumstances. All that said, I will say that there were a lot of people in my district, I have the southeastern portion of the U.S., who were not as aware of how connected they were to the global economy, and there was an awakening of some sort that took place, which is triggering a lot of changes. So you think about, we call it friendshoring or onshoring, like changing our policies in terms of businesses changing their policies in terms of how they are sourcing the inputs to production. Those sorts of things will have implications for how our economy works and how things will happen more broadly. And this is one of the things I think is actually quite interesting of the pandemic. This is a short-run episode, like a one-time thing. It is triggering really significant structural changes in labor markets, in business strategies, in production, and in a host of areas that we're all going to be grappling with. And those changes have not been resolved yet. They are still evolving.
Okay. Before we take a question from the app, let me just ask you one question, Giovanni. I was triggered by your question of policy mistakes. In the financial crisis, you know, economists spent a lot of time reflecting on financial frictions and its role in the economy. Do you think that in this crisis, we didn't understand the impact of the pandemic, or was it that it had to take a pandemic to reveal some cracks in the way we thought about theories of inflation and expectations and so on?
Yeah, so of course this is very much an open question. I won't give you a final answer on that. But my gut feeling is that we arrived to the pandemic where a very large shock of a complete new type hit our economy globally without a complete understanding of how that kind of events would have transmitted. And that created the conditions for the post-pandemic period where I would say probably the right amount of monetary and fiscal stimulation had effects that had to be corrected in due time. And part of what we were taking for granted as the flatness of Phillips curve might sort of induce central banks to underestimate the risks of a large sort of saving glut in the pockets of consumers, along with substantial monetary and fiscal stimulation. And I think in that sense, we need to start thinking more forward about what is going to be the right framework for the future, because we might be increasingly confronted with new types of shocks supply shocks that might challenge to the core the framework of monetary policy that we took for granted so far. So yeah, again, to reiterate one of the points I was making, probably we are slightly running out of the luck, and we need to think more carefully about what good policy might mean.
Thank you. We have questions from Zoom. Go ahead.
Hi, can you hear me? Good morning. So we have 3 questions online. The first 2 are from Mameketeli Jane from Standard Bank. First one she asks is, how do you think about the future of central banking in the context of high debt levels, rising debt service costs, and the increased volatility in rates, which could complicate monetary policy transmission? The second that she asks is, how do you think about the non-linear effects of rates remaining higher for longer? Does that not potentially introduce risk that we haven't seen before?
So, so the first one was about how you think about central banking in the context of high debt.
High debt levels, rising debt service costs.
Rising debt service costs.
And the increased volatility in rates, which could complicate the monetary policy transmission.
Increased volatility in rates. That's the first question. So let's get the second one.
All right, and the second one is, how do you think about the non-linear effects of rates remaining higher for longer? Does that not potentially introduce risk that we have not seen before?
The non-linear effects of rates. Non-linear effects of rates. Okay.
All right. The next question is from Sanisha Prikasamy, and she's from Momentum. She asks, how are developed market central banks effectively signaling monetary policy intentions to financial markets in a manner to limit negative financial market surprises? Is there a lesson in these methods used by developed markets for us in emerging markets?
Can we repeat that? I think we're struggling to get to maybe closer.
Sure.
Yeah.
How are developed market central banks effectively signaling policy intentions to financial markets in a manner to limit negative financial market surprises? Is there a lesson in these methods used by developed markets for us in emerging markets? So effectively, she's just asking about policy intentions and their signals to the financial markets. And the last one is from Andreas Tindland. He's asking Raphael Bostic, could you please share your perspective on the concept of average inflation targeting that the Fed introduced pre-pandemic, particularly in light of the fact that currently US price level is 7% higher than what would be expected with a targeted 2% average inflation rate since 2007?
Okay. I want to take this as the last round. Is there 1 or 2 more questions from the floor before we close? Anab, and then yeah. Go.
Thanks very much. Arnab Das from Invesco. I think it's clear on fiscal policy that in the U.S., we had this very large, 25% of GDP set of fiscal transfers. I wonder, though, about Europe, both the UK and the Eurozone or the EU. There was a significant amount of fiscal support for the energy shock, right, which neither of you have mentioned, Huw Pill and Giovanni Ricco. And I just wondered how you think that played into the inflation process, right, the price controls and fiscal subsidies for,
Last question, then we close up.
Yeah, Herman van Papendorp from Momentum Investments. I just want to know from the panel what their thinking is. Is this time different as far as the monetary transmission lags are concerned? I mean, is this related potentially to the fact that we've had such extreme accommodation as far as monetary policy is concerned for so long, and that we basically need to start measuring maybe the monetary policy transmission start from when we went from accommodation to maybe a more neutral policy rate?
Thank you. Giovanni, do you want to kick off? Anything you want to respond to?
Yes, I'll try and pick up a couple of questions. So on forward guidance and on sort of the communication, I think it's very important at the moment that central banks, especially in the euro area, clearly communicate that policy objective and that policy horizon. Conversely, at the moment, the euro area has been following what has been called a data-driven monetary policy. That is, they look at the last data releases and then they update the judgment, which is not entirely a bad thing, but when it's done, too much of it might be seen as driving by looking in the rear mirror, and there might be a tree in front of us. So there are risks to that, and I think the ECB will be well advised in providing large visibility to financial markets in order to avoid and minimize financial risks. In terms of the support to consumers in the euro area that were faced by large energy prices increases, that's absolutely true. It was very differential across countries. It was very large for some countries and much smaller for others. But I think that was in the remit of the normal conduct of monetary policy and not fiscal stimulation, of fiscal policy, not fiscal stimulation, in the sense that was providing a cushion to consumer against what would have been otherwise a very tight squeeze of the purchasing power. And I was showing earlier on the effects on real wages in the euro area. Finally, on the differential lags or different effects of monetary policy, I think it's hard to say at the moment, having very few data points so far. My impression is that the sum of QT and conventional monetary policy might have stronger effects that we might think, given that we are essentially intervening both on prices and quantities. And this is slightly new at the moment.
Thank you. Do you want to come in?
Yes, I mean, I also, just briefly on central bank communication, I mean, I very much agree with what Giovanni said. I think it's imperative now, for all the reasons we talked about earlier, to be clear about what your objective is and to signal your commitment to that objective. So inflation back to 2% in a lasting basis, that has to be the focus of all actions towards that end. Of course, the process by which actions feed into serving that objective is clouded by the uncertainties, both created by the big shocks we faced and also the uncertainty surrounding transmission and the propagation of those shocks because of their magnitude and in some cases unprecedented nature. So there is inevitably a sort of learning by doing, and I think that's led to this greater focus than in a sense is desirable on latest data releases and data dependency and so forth. Ideally, one would be using the machinery of inflation forecasts and so forth to sort of bridge the gap about how those data releases and news, how that signal or what signal can be extracted from that about the objective of policy, and that is challenging in the current environment. But what I think it is also important to emphasize, a bit to control some of the risks that Giovanni mentioned, is that the latest data news, I think central banks need to emphasize that they interpret that news from this sort of more medium-term oriented perspective. And I think there is a danger that absent that, policy rate expectations can become a little bit unanchored, a little bit volatile, and that can be costly, both in terms of financial stability, but also in terms of the effectiveness of transmission of policy. And that goes back to this point about the sort of table mountain view of rates, a bit more predictable, a little bit more medium-term oriented, trying to extract more of the signal in these about medium-term price developments rather than have a kind of very volatile, very excess, in my view, sensitivity to latest data releases. On the fiscal situation during the energy, I mean, the UK experience is not dissimilar to that in other parts of Europe. We did last summer have a sort of hiatus in the political situation in the UK because there was a change of leadership and so forth. And that led to some complications. In the course of August, European wholesale gas prices basically doubled to these very high, unprecedented levels. In every other European country, there was quite prompt fiscal response. That didn't really take place in the UK because of this political hiatus we faced. And that created a sort of number of practical problems about what we assume for forecasts. Like Raphael instructs his team, we want to be taking announced fiscal policies, but where there are no fiscal announcements being made, even though I think they're likely to take place, that created some challenges for the practicalities of our forecasting, given that we condition it on announced government fiscal policies. So communication has proved challenging in that environment, and that created its own set of difficulties. But I think the fiscal support was both justified, quite significant when it came, and supportive of macro stability. Just to go back to the previous question on financial stability, Raphael emphasized the sort of banking system in that context, and of course that's key. If you go back to the UK experience a little bit less than a year ago, in the autumn of last year, in the fallout from the relatively large fiscal support, the change of government, the famous mini budget, which announced very aggressive fiscal easing in the UK, that did disturb financial markets and had an impact on the non-bank financial sector. So I think just to sort of refer back to that, there are other sources of potential instability in the financial sector beyond the banking system, and we had to act in order to contain that, and that produced its own set of communication and other challenges. So the relationship between monetary and fiscal policy has its own set of issues, I think, and that's an illustration of that. And then in terms of, is this time different? I mean, I think every episode is special in its own way, and we need to be sensitive to the specificities of the special. One thing I would emphasize, and I think it's in the spirit of what you said, is that, and it goes back to what I was saying earlier about this blunt tool, powerful tool, but blunt tool, is that I think monetary policymakers in the current environment, we do need to be cautious about thinking that we can fine-tune developments and we can respond effectively to any potential challenge. We need to sort of choose our battles and make sure we're focused on what our objective is and so forth. That chimes with the kind of communication issues that Giovanni mentioned. I think there are good reasons to expect that we will see there's the famous long and variable lags of Milton Friedman. A sort of key issue was they're not just long and variable, but they're also not fully predictable. And it's the lack of predictability about those lags that introduces a need for caution and a sort of guard against activism in the conduct of monetary policy. And I think that's something that's a kind of lesson that we should take seriously in the current environment, precisely because starting from a long period of accommodation, the difficulty in judging when you move from an accommodative, supportive stance to a restrictive stance, which you might say in the technical language of this is estimating where our star lies. But also the fact that changes in the structure of the economy, one thing I would have mentioned but didn't have time is around changes in the structure of the UK mortgage market, how that's affecting transmission, and of course, in general, the difficulty in real time of estimating how transmission is working and evolving, given that the data we have in a sort of post-pandemic, post-energy price shock world remains too short to do sort of traditional estimates. I think all of those things point to a need for some caution in thinking about how the lags in transmission and the transmission process more broadly worked. And I think that in turn supports the idea that central banks should focus on their medium-term objective. We know more about how monetary policy works through time rather than how it works in sort of higher frequency developments. And I think maintaining that focus on the medium term therefore becomes important.
Thank you. I thought I was managing time well, but I'm sure Raphael would save me.
I'll do my best.
Yeah.
So let me say, I agree with what both Giovanni and Huw were saying in terms of the context for policy. We always want to know in real time, is this different? And historians will be the ones who actually answer that sort of years from now. What I will say, though, is that the context that policy happens in is ultimately the determinant of the extent and the nature of our policy transmission. In the US, when we announced that we were going to start moving our rates upward, there were many interest rates that moved much further and much faster than we moved. Mortgage rates jumped from 2 and 3 to 6 and 7 almost instantaneously. The degree to which that affected people's decision making, though, was informed and shaded by the amount of money they had in their savings accounts and other things that they were thinking about in terms of where they're going to move and all that kind of stuff. We do a lot of surveys with businesses to get a sense of what they're thinking about. And in the first 2 years of the pandemic, we kept asking, are you going to stop or reduce your capital investments, your long-term investments, because of high interest rates? And the answer was uniformly no, that they had a lot of cash on hand, and that they were positioned to be able to move forward on things in ways that they hadn't been in previous episodes, and part of that was because the fiscal supports were there, and consumption continued, so they didn't see reductions in revenues. That was a very specific case. So if you want to ask, does transmission change, you've got to figure out how much of the effect that we would have seen was substituted out by policy actions that made those things unnecessary. And then further, once the policy has played its way through, how fast would you expect those dynamics to return to something close to a historical level? These are very hard questions, very much more difficult to answer, I'd say probably impossible to answer in real time. But these are the things that we'll talk about. I will say I've been struck in this role about expectations about what we know, perceptions of what we're focusing on, and our collective reaction function as a central bank, much more than I ever thought I would when I started this position. And it's because as I've gone around and talked to people, and we do a lot of outreach, I talk to a lot of businesses, a lot of families and consumers, a common refrain I get is, I wish we knew with more certainty what you were going to do. I wish we knew that when the date you were going to stop raising interest rates. And you know, we do a lot of things. So we have sort of a summary of economic predictions. We do dot plots. We do all this sort of stuff to try to tell people these things, but we're still not telling them in ways that are being fully digested. And so I think it's inherent in us collectively to always try to do better, always try to do more, make it clear that we are both backward-looking and forward-looking. You know, you've heard us both talk a lot about the surveys that we're doing. We're trying to get information about the future and not just taking sort of the official statistics about the past as the only inputs to our decision-making. And that we actually really do have a deep understanding of the experiences that families and businesses are having, and that is informing a lot of what we do. Those are things we need to be saying more often, more clearly, more consistently, in regular people language. You know, I'm an economist, but you know, most people when they go to hear an economist talk, they expect to understand 30% of what they say, which I think is problematic. I think trying to get them to understand 100% is the goal, and the more we do that, the better we'll be in terms of making sure that our guidance, our talking about what we're doing, is more deeply understood, which will ultimately lead to better long-run decisions, more productive capacity, more innovation, more resilience, and ultimately a more stable and prosperous economy. And so that's what we need to aim for, and I think how we talk about it is going to be quite important.
Fantastic. Once again, I apologize. We are going to break for tea, so thank you very much to the panelists and for a fantastic session. We'll be back at 10:30. Tea is outside.